You can start, sir.
Right, thank you. So it's a pleasure once again to be on this platform to interact and engage with the budding, entrepreneurs, people who have got the sort of vision to contribute to the economy and being employers and not employees. So wonderful. Always loved it. So today I will be, sharing some of the perspective with regards to the financial aspects of it. It's not going to be a financial management class because that's not required. It's more about certain basic and fundamental aspects which, typically when we start our business, we tend to lose sight of it in the garb of being more revenue top line driven in terms of making sure we have our returns coming back to keep our investors, fulfilled in terms of the promises that we have done. And we tend to sort of, do an oversight on certain financial fundamentals. I will be sharing a spreadsheet in between that is just more of a format, and it is already there with Tai, with Shreya. If anybody wants, can use that, because that's sort of a fundamental spreadsheet that I and my team put together for one of the startups whom we were trying to, create a sort of a framework within which we can, have those numbers and other things captured. So 4 takeaways is what I have mentioned. One is the basic. People tend to, mix both interchangeably of finance and account, which is not actually the case. I'm sure some of you would already know about it, but yeah, we tend to kind of, do that interchangeably. Forecasting is very important because for any business, you need a proper forecast, which is though with a guesstimate, but has to have a lot of logic and rationale behind it, depending upon the ecospace your startups or your business ventures are. Measuring the performance is very important right from day one. It should not be when we have started getting funding and we have started moving away from the startup zone to become maybe mid-level startup or unicorns. And by that time, there's so much of water which has passed away. Perhaps people tend to lose out. And so we'll talk about forecast, budget, and actuals. So we'll touch upon why forecast and why budget. I mean, both of them looks to be similar, but they are not. I'm sure people would agree with that. And last but not the least is raising capital. When you look at in today's context, what should we do when it comes to debt versus equity? So these are 4 things which we'll be having our discussions around it. So instead of me talking about the first, can anybody tell me, or maybe, accounts and finance, typically people tend to, mistake, finance means everything. Yeah, finance means everything. But when I'm doing my accounting part, and if I'm not maintaining my records, I'm not registering every paisa that I'm spending or every dollar or cent I'm spending, my finance is a mess. And that's typically the case, where we do not realize it. And we tend to say it's a very small amount, it's a petty amount, and we tend to maybe, just shy away. And that becomes a leakage in the system. So accounting, therefore, starts the fundamental threshold of putting a proper financial system in place. If we do not have proper accounting, if we do not have proper bookkeeping, it's not going to work. So it has to start from that maybe. And for that, we need people. We need the right person who will do that job. So accountant may not make a balance sheet, but an accountant will make sure that every money is accounted for. It is going into the books of record, and that will help to get the right balance sheet and P&L, which will be later used for taking financial decisions. And more often than not, we miss it out. I can tell you many examples of startups which have, where I have myself been associated with one of the startups after I left my banking career in 2014. And that startup was basically into career consultancy and doing some IT solutions based in Bangalore. And initially what I thought was, when I saw the promoter basically, used to look at a lot of cash expenditure happening, a lot of cash payments happening, but there wasn't any record. And there was an accountant, mind you, there was an accountant, but it was like, accumulation of expenses, accumulation of, payouts happening, payments coming in, but the accountant was not being given that on day 0. Day 0 means on that same day. After 2 days, after 3 days, after 5 days, some receipts were found, some receipts were not found. So later, when the accounts were being made and when they sat down with the books to be matched to see the finances where they stand, they always felt that, they were running short and they were not generating enough amount of money or cash. And that was one root cause which was easily identified. that, and it became a practice, because the promoter or the founder was always in the garb of, getting sales, getting business, getting revenue. Though it was a bootstrap, mind you, there was no investor, it was a bootstrap. So again, it was more his money and he was not accounting for it, and it became a problem at some point of time. So when that firm went for a kind of a valuation to seek funding, they had severe issues, severe issues. So this is real-time example which has happened when I was there, and it looked very fundamental that people who have come from industry experiences are missing out this bus, are missing out such a basic aspect of it. So therefore, accounting is essential right from the day one. Whatever comes in the firm or goes out of the firm needs to be accounted for. And that's the purpose. All of you know that. I am 100% sure. All the 31s over here know it. But in our own reasons, we tend to have an oversight, and that becomes a problem for your CA also tomorrow when he sits for the accounting, when he sits for the sessions and everything. So that becomes a problem when he's finalizing the accounts. So you can imagine the snowball effect of it. So that's the reason why we need to make sure our books are right, our books are straight. I have seen some of the people who are right in a very small startup phase, who have just started, who have not even, gone to the stage of, putting the product protocol ready. And they tend to, do a lot of expenses, paying money, this and that. But again, they're not accounting for it. All this leads to further funding problems also, because when you're raising capital, you go to an investor, when you go to a bank in the form of a debt, or you go to invest in the form of an equity or whatever, they will just look at the books, and the banks tend not to give any kind of a debt because your books are absolutely in a shoddy affair, simply because you did not have the numbers correct over there. So yeah, that is the basic, the hygiene in terms of managing your finances. People think we manage finance when I start raising capital, when I start getting revenue, when I have a large team of 50 people, when I have a big office, I have, a lot of people, then I start looking into my financials and see how I'm performing. By that time, you have already lost 25 to 30% of your money, which you got into your system, either through revenue or through any kind of capital, because there is no record for that. So you just tend to give it up, and that goes unnoticed, and that goes completely unrecognized as far as your financial performance is concerned. So it has an impact there also. So all this leads to multiple effects over different kind of cycles, which you basically look at it, right? So this is the basics of it. I don't want to dwell too much into it. It's quite self-explanatory. The purpose is to impress upon the point why this is critical, and why, therefore, we need to be mindful of these basic hygiene stuff. And doesn't matter, regardless of whether it is a young entrepreneur, a mid-age entrepreneur, an old entrepreneur, whether it's a male or female, doesn't matter. These are things which definitely miss the eyesight. And I've seen that happening across, even as a professor of finance, even as a banker in the past, and even somebody who worked with a startup. This has been a common phenomenon. So yeah, this is one basic aspect which one should not tend to lose at any given point of time. So that was one aspect of basics. Now, when we say financial forecasting, what are we doing? So let me share my sheet over here. Perhaps that will be something giving you a better perspective. Yeah, here it is. So I know you all are on mute and your chat box are disabled. I presume you can see my screen. Now you can see my screen. So yeah, this is just something, we have put across for basically keeping a business model in mind. And that's the reason we are kind of, showcasing it. So it all starts, what is forecasting? So I need to look at my time horizon. My time horizon is starting from now, when I'm getting into the core operations part. And there are two parts to it, pre and post. When I'm before starting, I need to have a forecast. What is the kind of, what product I will be making? What kind of go-to-market strategy will it be? What kind of initial expenditure or capital I need to put it? So there has to be a forecast, and that has to be noted down. So basically, at least bare minimum, one needs to put down the revenue side, the expense side. So the receipt and payment, the fundamental of any financial hygiene, receipt and payment has to be there. What comprises of your receipt? ABC, it could be the revenue, it could be, receipt in the form of, coming into the any type of cash coming in, be it capital, be it debt, be it revenue. So you segregate it in different categories, but it will be still part of your inflow of money coming into your firm. Payout would be any kind of obligation that you're making, be it your salary, be it your promotion expenses, be it your investment in buying a machine or anything else. That's your payout. So your pay in and pay out should be very clear. Segregation of that happens subsequently. But if you don't record the pay in and pay out, the entire forecasting goes for a toss, because you are paying out something, but you're not forecasting for that. And that has an implication on your cash flows, future and current both. Now you see over here, something which I called as a discounted cash flow. Then I talk something on marketing, advising, salaries, advertising, salaries, and direct expenses. These are self-explanatory. And so this is on the side of my payout. This is on the side of my revenue, which is coming in over here. And this is my operating margin. So simple. What I expend versus what I gain, difference between two becomes my operating margin. Appropriation of taxes becomes my PAT. In simple English. This is the least of, you should know whether your efficiency of your money that you're bringing into the business, how efficiently you're utilizing it. Discounting cash flows is something we tend to miss out, and we presume that this is the work of a bank or a financial institution. Why should I be bothered about a discounted cash flow? But mind you, when you're doing your business, everything is not coming to cash ASAP. It's coming in the future. It's a credit sale you're doing. And that's how you're able to generate business and revenue, show it in your balance sheet. My top line is so much, where most of the top line will be credit. Now that credit is going to come to you over a period of time. Now you could be a 60 days credit, a 90 days, 45 days, depending upon your competitor, depending upon the industry in which your startup is going to be there. So it's a function of that. There is no right or wrong or standard, what is going to be my credit period. That is your call based on your working capital. What is working capital? Basically the expenses that you are going to be incurring versus what you will be getting on a daily basis. That's another component which is important for a startup. I need money on a daily basis to make small payments. Where am I going to get that from? Because my customer is not going to pay me immediately. Everybody needs credit. Maybe you're also taking raw material on credit. So you're also using somebody's capital to run your business. And likewise, it happens with others who are taking the goods from you. So therefore, discounted cash flow is why important, because expenditure is happening in today's time. Your revenue is coming later. The value of that revenue in terms of time value money, because you are using that money in the future with the discounting. What is the discounting? Inflation. Time, the value of money is going down. We have seen in the 1.5 years past what has happened to rupee value. Recently also it has gone down versus the dollar and other major currencies. So when I am looking at my cash coming after 60 days, is that cash equivalent to its face value? If I'm getting 10,000 rupees after 2 months, is it really 10,000? It's not. It's gone down. But what I spent on that was the actual value in current time. So when I use the same spent out of this money coming 2 months down the line is going to be higher. So I will not get 10,000. It is there in my bank account as 10,000 cash. I have 10,000, but I've lost on that 2 months of time value. That's called opportunity loss, which is very important. So we'll have to look into that. Many times we do not look at, we kind of tend to forego because it sounds very small. I'm doing a business of 20 crores or 30 crores or 20 lakhs or 10 lakhs or whatever. Yeah, to that extent, it is hardly some few rupees or few hundreds, maybe. But what we also need to understand is that your payout, when it's happening, when your inflation is going high, the economics are not in your favor. When I say your favor, not as a startup, mind you, as an industry, as an ecospace, there is the time you then realize the pinch that it hits you when you are not able to, sort of save on that inflationary pressure on your payout, because the incoming money is definitely lesser than that particular value. So if I'm going to get 10,000 after 2 months, it is actually going to be maybe 9,000 something, 9,500, 9,600, 9,800. But I have to make an expense payment after 2 months. It will not be 10,000. It will be more than that because inflation or the rupee value would have gone down further. And that holds true for every currency. It's not only rupee. In that economic context, the value of the currency goes down over a period of time. So let's not confuse this with rupee versus dollar. It's an economic concept which is hitting your finances also, which is opportunity loss. And it's true for every economy. It's not just a economy which we are talking about today. So forecasting, therefore, has to be kept in mind that what I'm going to be talking about in the terms of revenue coming up, expenses which I'm going to do, and what is happening in the larger market space with regards to the inflation, with regards to the currency. These are three things which has to be kept in mind. Now you might say that way we cannot do business because it becomes difficult. I'm not saying stop doing business. Be mindful of it, capture it, factor it into your forecast so that you know actually what is there. It should not be a surprise after 1 year or 6 months when you take a stock of situation that I had forecasted this value, but what I'm getting is actually lesser than that. So it should not be a discovery after 6 months. It needs to be pre-explored, pre-ascertained before you hit that 6-month cycle or that 3-month cycle whenever you do the performance review. It's very, very important. And forecasting has to be, I can't say it has to be 100% correct because you can't forecast everything. And I'm not even saying that you should be very conservative or very aggressive. Both approaches are not recommendable. Needs to be balanced, needs to be realistic in the context in which you're doing the business. We should not miss it out. So the challenges which come up, which we tend to forget to forecast, is in terms of the expenditure, in terms of the capital expenditure, in terms of some certain revenues, which we feel may not be accrued at the point of time we feel, because the way things are happening out in the industry may not be very different to what you're doing. So any capital industry, for example, you have a manufacturing unit, which requires intense capital. But the cycle of churning a raw material into a finished product and then distribution and then to the last customer as a sale and that coming to cash is taking a longer time. And if you think, even with the help of technology, you are able to crunch the processing time, but the distribution and the sales and the cash conversion will take its own cycle because that's a consumer mindset. You cannot change that. Technology cannot change that. You cannot drive that behavior. So that has to be seen in the realistic term and then say, okay, yeah, I will get my cash maybe after 6 months once I give this product. So that 6 months period, how am I going to manage my finances? How am I going to manage my cash? Where is the money going to come from? Because I will keep getting orders. So when I do my forecasting, it is about my long term and my short term. When I say short term, in terms of what is that short term? So day-to-day expenditure, my operating expenditure, my salaries, my wages, payments to vendors, payments to suppliers, payments to other, any kind of, regulatory related payments. All of that has to be thought of. They cannot wait. So one has to manage the assets and the liabilities of the firm. We often hear this concept today, and this is true for forecasting because that's where the firms become really strong if the forecasting is properly done, keeping the assets and liabilities into consideration, keeping their expenses and their payments into consideration, receipts and payments into consideration. If we do not do that, by whatever might happen, we will miss it out. We will have a problem over there. And this asset liability problem or the payment or the receipts problem is not only banks or big companies, everyone. So you have to know what is that you need to run your business in terms of the capital, how that capital will be used to convert sales and drive your revenue. So that becomes the kind of operating efficiency of your business model. And that operating efficiency should be clear in your mind, based on which you can make a forecast. So certain things we have this is a very basic sheet I'm using over here. And there's something which is the CapEx part of it, which includes all the capital expenditure. So whatever systems you need, laptops or machine or computers, whatever you need over there. Employees is very important. And you need to know what employees. Are you want to take them full-time or are these contractual? Which means full-time means they're going to be sitting on your books as a cost and you have to pay salaries. Now, whether they give the productivity or not is secondary. That again has to be thought of. So is your business model which you need a full-time or you need somebody which is there for a particular period of time? Say you may have a fruit business, or you may have something in the food tech, which has got seasonal peaks and troughs. There you need to do the right capacity planning. So the right capacity planning, it is not just putting machinery, human beings, etc. The financial resources has to be apportioned and forecasted properly, budgeted properly. Because if you don't do that, you land up into forecasting something and budgeting some more. I forecasted that I would need only 3 full-time and 20 contract employees to run my restaurant business. because there are going to be seasonal peaks at the time of Deepavali and festivities. Okay, so I forecasted that. When the budget came, what we did was, what the entrepreneur did was, he hired 6 people to make sure that, I don't want to depend on variable resources because of higher attrition. So let me have fixed cost on my books. So the budget has already gone differently. Forecast was 3, you've gone up by 3 more because your thought process changed, right? So that again puts pressure back on your money part. Because had it been contractual, it would have been for a fixed period of time during the time you were having business. So whatever came in, you could have paid from there. So there the forecast went wrong. Then we look at, so employees is very important, and the right employees, which is not mentioned here. Most of the time when we look at forecasting and we do our estimation, we say, I want 5 people in sales. I want 2 people in marketing. I want 3 people in finance. What are they going to do? Are they all going to sell? Are you asking about somebody to do a telecalling business? Are you asking somebody to go on feet on street? Or you want a digital marketeer? That level of understanding, that level of clarity has to be there when you do the resource mapping in terms of which is skill-based. So today, now, if you look at it, it has to be skill-based resource mapping when you look at any kind of, entrepreneurship, which means you have to know exactly what you're going to get that person do. Then decide whether it's going to be full-time or it's going to be contractual. That's a secondary discussion altogether. But if you don't have that clarity, we may get something which is not going to fit into a scheme of things. It's a waste. It's a drain on your operating expenditure. It's a drain on your working capital because you're paying somebody who has got zero productivity. So these are all leakages in the finances, which you don't tend to realize. And we think that the person is inefficient. He's not inefficient. You hired the wrong person. And there's a cost gone into it. Your cost of infrastructure, your cost of training, your cost of investment of time, which is not measurable. And that is where we get in, we don't understand, we realize it. So those things become very important when you look at the CapEx side of it. And of course, these are all mathematical things, what is required. So it depends on business model to business model in terms of what we look at the CapEx. Your infrastructure today, everything is digital. Everything is digital. So your data cost, your cloud cost, where you're going to store the data, for how long, what is the retrieval period going to be? What is the purging period going to be? Because the more the time data is there in that cloud, it is occupying space. And you are doing digital business on and on. So it is going to have an impact on your storage capacity also. So there has to be some point of time where the data is purged, it is taken as a backup. It's basically, taken up in a different repository. So you create more space to get more fresh data. Again, one does not think about it because it's just the start. We start thinking about it later on. May not be having the data then, it's fine. But at least think about to provision for it. Because every business is a going concern and it's a simple fundamental. So if it's a going concern, automatically it means that you need to make sure that there is enough space for to think futuristically. That is where we talk about the technology infrastructure, right technology. More often than not, I have seen startups, I've seen banks, established banks, they're not startup category, using suboptimal obsolete technology, which puts so much pressure and makes the system inefficient. And we blame technology, we blame the CTO, we blame the entire tech team for that. It's not their fault. If I need today a robotic process automation, where I need to have the more advanced or more better AI platform or machine learning tools and techniques to put up a solution for a problem, and I am still depending on the redundant and the remote technology, which was used to be there at some point of time, maybe a C++ or something, I don't know. It's me to blame. I'm putting my money on the wrong horse, which is not going to make me win the race. Because that horse is not going to run, is not going to give that efficiency and speed and productivity, which this AI-driven horse will give me. It's as simple as that. So we try to cut corners on technology, that why should I put money in technology? Because it's not giving me returns. I mean, I know the thought process has changed now. It has changed after so much of debacles and disasters that the entire world and the global markets have seen. But having said that, even today, there exists that peace of mind. Can I cut my technology investment? Can I do some trimming out there? Why? So that I can put that money into a product or into sales to get more business. Still, a CEO has that thought, unfortunately. May not be so much, but this much is always there. using obsolete technology. That becomes a problem. So CapEx again has to be a function of what your needs are and have the right resource, which is technology, human manpower, skilled manpower, and moreover in terms of any other infrastructure related cost, data cost, networking cost, storage capacity of the data. All of that has to be thought about in advance. You have to be futuristic. That's all about how you envision your business to be. It's not going to be start and maybe after 6 months we go for a valuation and it's shut shop. So definitely CapEx becomes very, very important from the forecasting point of view. There are certain assumptions. It's always important that we have a kind of, perspective about it. So that comes over here. And then we come to this income statement part, which is exactly what I had talked about some time back, almost 20 minutes back. We should always have this at our end. This is almost close to 3 years, 4 years kind of a projections we have done. Now, one might say at the beginning, how can I do that? It's not so easy. It is. You need to be forecasting. When I start, this is the bare minimum capital I start with. This is what I will do my break even. People straight away jump to growth, profit growth, sales growth, revenue growth, market share. You're not even started right now. You're not even entered the market. Your product has not even been accepted. And we're talking about growth. So there has to be a point where it has to break even. What is break even? Where your cost and your revenues are the same, almost same. I mean, you don't have much of a difference. It cannot be same always, but it has to be on the same page. That has to be realistic. And that is where 90% plus startups, entrepreneurs don't have the right precision because they don't want to be realistic. They want to be conservative. They want to be defensive, that I cannot show a long break-even point. Because if I show a long break-even point, my investor will say, boss, it's too long. Sorry, I can't wait for so long, where I have to wait for 3 years to get my investment back. I'd rather go to somewhere else. And that fear of that losing investor, we put numbers which are aspirational, non-realistic, and we face the music not now, but after 3 years. So we are just deferring the problem to 3 years. The break-even has to be very accurately assured. And it's not difficult. You have the market data in front with you. You know what the competition has gone through. You know how the space has evolved. You're mindful of the compliance and the regulatory policies of the government and the world at large, which is going to impact your startup or the industry that you're part of. So definitely you have to be, I would say, accurately doing the right, I would say the break even, keeping those parameters. So numbers is secondary. Have you looked at the component which comprise the break even is important. I should not be missing out any component of break even in my cost, which is short term, long term, my cost of my funds, which is interest cost, the money that I would be paying out for my business promotion, the revenue when I would be getting it, what I would get upfront, what I would get later, at what duration I will get it. All that matters a lot. These are basic components. And if there are incidentals which are not in my control, where I don't have any, I'm not in something beyond my control, maybe create some kind of a contingency for that, so that it should not affect my cash flows or my profits at a later point of time. That is what we need to understand. So typically we basically look at, something in the world of business, which is called as leverage. Now leverage, people often think that it is only got to do with the financial leverage, the operating leverage, the interest costs. Yes, it is one major component. But leverage also means that what am I incurring to enhance my sales, my top line, and getting economies of scale to flatten out my expenditure. So with less amount of expenditure, with less amount of cost and resources, how much more am I able to produce? That becomes my operating leverage. And that helps me, if I'm able to do this particular fundamental properly, it helps in creating more profitability and all your EBITDA and all that terms. It's more of, jargons at earning before interest, tax and depreciation and all, just to look at how the numbers. But the operating margin is what matters today. Net profit is something which is adjustment against taxes and other things, which is regulatory driven. but you are measured as a financial performance based on your operating margin. So how efficiently you're managing your capital in terms of the interest cost, plus churning that out into sales, churning that out into production, and getting money out of it is the whole thing that you have to make sure in your forecast is, if not 100% correct, close to that. Where you need to be realistic in terms of the economics, real in terms of the market, real in terms of the situations around you. Whether, and it could be for anything. Today, it's all technology driven. Everyone is into the ed tech space or the food tech space, the agri tech space. It's all there. So people assume that there is an infrastructure cost which has gone down. Perhaps, but I would not second that. There is another cost also to maintain the data, investment in technology, the right technology, because today it's agnostic toward location. You have people working in your organization. You might be centered in Bangalore. Your team might be sitting in Delhi, in Pune, in Nagpur, in Nasik, in Indore, in Calcutta, in Assam, in Guwahati, because there are potential markets to do the business over there. So, but they are sitting on, when I say means, they are in that coterie of in those locations. So they don't physically don't need to come to Bangalore, but they're still doing that business for them, for the center office in Bangalore. So data has to be there. And the speed of data has to be there. So your physical brick and mortar cost is now taken over by the technology network, the data, how efficient it is, because that service today is one of the key parameters which is looked upon by any customer, and it has an impact on your financials. So this is basically where we talk about income and expense statement, which again are just common, which are all basics. I am not talking about anything which is very technical or jargon. Indirect cost is there, employee cost is there, other expenses are there, and any expenses which is related to your business, one has to factor that into account. This is a framework. This is just a structure that I'm trying to show you all, right? Then, of course, the balance sheet, because that's where it all boils down to. And then we look at the capital part over here and the liabilities part of here, how you are managing both in terms of driving a business. I've spoken about it at large already at length in terms of what balance sheet finally would culminate into is an outcome of right from the beginning of your assumptions, your forecasting, the budgeting that you have done, and how actuals are you performing. So forecasting, to forecast what your business model would be, how much you would be sustaining in terms of the business operations. Budgeting is going to be the allocation of resources against that forecast. So if I'm expecting to have a forecast of growing my business by 25% year on year, where I see my sales going from 1 lakh to maybe another 2 lakhs odd number in the 1 year, what is the resource requirement for me? Number of people, number of skilled people, the technology, the kind of working capital, the capital I need. So what is the debt I would need, or what I would go for an investor to ask money, depending upon my future growth. All of that has to be measured accurately. Now, these things, if you miss it, you will not realize it on day 1 or day 30. It will immediately come to your face on the 31st day, and you see there's something happening which was not expected. So that becomes your budget part, and actuals is basically comparison of what you thought, what you allocated, and what you have actually performed. So these 3 dimensions will tell you, gives you the picture of your business model from what it should have been to what it is. And that's very, very important. This is the cash flow statement, where I think it's important that we understand the need for it in terms of what is my cash outflow and what is my cash non-outflow. So do not, again, this is again specific to certain components of for that particular business for which this framework was done. But largely, again, cash flow means inflow of money and outflow of money in what types. So some of the times we allocate a cost, like a depreciation or amortization, but that's of course adjusted against my incoming revenue, but it's not a physical cash outflow or inflow. It is more about appropriation of an asset which I'm using over a period of time to arrive at the real value. So that is the reason I make sure that it is done to more keep in line with the taxation policies and the guidelines of accounting standards. That's the reason we are putting it over here, right? So that is where we get into the cash flow part of it. And of course, this becomes your valuation sheet, etc. So that is very, very important. And then last but not the least is your weighted average cost of capital, because you're borrowing over a period of time. And as a result of which, it is going to be looking at your cost of funding, where it stands today. So because interest rates keep varying, Your need may keep varying. You may be borrowing from the market. You may be borrowing from maybe at a point of time where the leverage, where the cost is very high, because you're not able to get money at a cheaper rate. So all those things are considered to look at your weighted average cost of capital, because that's again a leverage. It's again a test of your efficiency to what you're procuring, at what cost you're procuring, and putting that into your business in the form of capital to create more business, to create more kind of revenues and sales for your organization. So weighted average cost of capital becomes very, very important. Don't get into the technical terms. I mean, this honestly needs a much more bigger time if you were to ask me to run this session. But given the constraint, I'm just touching upon the basic aspects, concepts regarding the financial management, which as an entrepreneur, you're supposed to know. You may have a chartered accountant, you may have a CFO, you may have a person who is going to manage these things. But as an entrepreneur, if you do not know, believe you me, you will have those people in all their fairness, not with any malintent, taking things in the way they think is convenient, which can impact your business. I was part of one of the events of HCL Tech Foundation, where there were a lot of these NGOs and these Section 8 companies over there, and those people were in the similar phase of what their startups would have been, and they had given everything to the CAs, and after all, they are managing so many things, and because of oversight, they forgot to do a compliance regulatory filing for some of the submissions that you got to do as a startup, as a Section 8 company. And that resulted in a penalty, and that had to be borne by that entrepreneur. And moreover, when his venture was not even in the phase of, had just taken over, which he did not even budget. It was not even forecasted, it was not budgeted, because why would I fail? Why would I breach? Why would I pay a penalty? So I don't even think about it. But then he was hit with a 3 lakh penalty. Now, that's a straight hit to a startup on his profit line. And an entire budgeting, entire resource goes for a toss. If you can't, because you can't shrug it off. If you shrug it off, shut shop for you. So obviously, these are certain things. If we are mindful of it, we are aware of it, definitely it helps. And it's always important because the ownership lies with the entrepreneur. You cannot put the ownership back to somebody who's representing you in any form. So that's why this is important to understand these fundamentals, and does not matter regardless of what previous sort of domain or what sort of previous background one has come from. This is today a hygiene. It's a must thing one should know, and should know at this level. It cannot be periphery. It cannot be at a high level, because that will not work. Believe me, it will fail, because these are smaller things, basic things. One tends not to look at it. So that is the reason I'm just touching upon these aspects of it, why one should be mindful of it, calculations of it, the meaning of that. We can definitely have more sessions on that in terms of technical know-how. But yeah, to know these components, it's more important from the eco space in which your startups are going to be. And it has got nothing to do with the type of startup. For any startup, for any venture, for any business, this is utmost important. Right. Now, this is basically the expense bifurcation which we had done for one of the startups, because that was more startup which was having a space in the fintech space. They were providing escrow services to their customers. It was subscription-based model, so we had put this model over there for them. So that is why we put this whole sheet. So yeah, in this term, last but not the least, raising capital is something I would like to spend a few minutes on that before we can take it for questions and answers. Now, raising capital, typically bootstrapping, Series 1 funding and all. In the last couple of years, the trend has changed. And I was looking at one of the reports published by, I think it was Economic Survey of India, or it was Indian Statistical Institute, or I don't remember. I'm sorry, I don't remember the source. But they said that the investors today have started now diluting. They've started moving away, and they're more expecting the startup entrepreneurs to, instead of go for debt in terms of raising capital, than equity in the initial stage through various series level of funding. And I'll tell you the reason why. If you look at the dip which has happened in the series, the funding which has come from the investors across the world to India has taken a big dip. And they've all moved towards the debt side of it, because that's where they recommend that you can raise capital. One observation which came out was, and this is not specific to a community or to any specific region, was that the people who were running the startup were using that money to pay off their fixed expenses. So if you're paying off your fixed expenses based on the capital that you're raising from the investors, what is the motivation that investor has got to put money in your venture? Because that salary is not going to give you the return. Return will come only if that capital is deployed in the business to create a sale, to create a revenue, and then it comes back as a return, which is going to be reaped by the investor. So if you're putting your money, I'm taking 2 lakhs from you, I have to pay salaries. I don't, and instead of putting that 2 lakh into my business, it's gone for salary payment. And you come to me, and tell me, hey, look, you told me you'll be giving me X number, a percentage of return after 1 year. Where is the money? And I don't have a face. I will say, this is what has happened. So one needs to be protective about the work, needs to be very clear. The kind of money sometimes you have to spend from the pocket. Often than not, if you look at the government projects, if you look at those kind of projects, the funding happens slightly slowly. Money comes very slow from the institution. For whatever reasons that might be there in the ecosystem, I don't want to discuss into that. But as an entrepreneur, I need to budget for that. I have to be mindful of that foresight. So I should have some reserves with me where I can at least pay the salary. I cannot go to the investor and say, boss, give me money, I have to pay my salaries. That means your business model has been not thought through. You have not forecasted or factored these kind of uncertainties, because these are very much I would say the criticality is very high, because you're still not self-sufficient. You're still depending upon external funding. So hence, this approach definitely does not work. So one definitely has to look at reserves at his or her end. Yes, as a business entrepreneur, and that's what you call as bootstrap or whatever name you want to give it, but it has to be there. And then the alternate, because of this behavior, they could not see the reciprocation, so they've gone down to a significant extent and said, why don't you go for debt? So now, in fact, you have banks today. I'm not talking of small banks. I'm not talking of microfinance companies. I'm talking of nationalized banks. I'm talking of banks like SBI, banks like IDFC, banks like Yes Bank. They have started the cells. They have started the department or a particular vertical where they only help startups. Of course, in their incubation stage, at different stages of the startup, depending upon the business model, depending upon the sustainability, depending upon the scalability, all of that. So there are now windows open from those strata of financial services, which initially were not willing to fund the startups. So that is one wave of getting, and of course, it's not so watertight in terms of giving you, it's not watertight in the sense of saying no to you. It's more in terms of doing the right assessment and then asking you to take money. And of course, they have their own criteria. So again, the eco space of raising capital is changing in a big way. So the traditional way of raising capital, which used to be through different series of funding or bootstrapping is still there, but yeah, it's gradually moving into the debt phase where you're raising debt. And of course, when you're raising the debt part of it, again, forecasting part of that in terms of the cost of debt, the money that you're going to be raising is going to be very important, because how you leverage that money, how you utilize that money to create maximum amount of productive business output is going to be very key, because you have to pay the interest. You will need to pay the interest for that. And of course, what is the criteria for banks to give the loans or those things? Definitely, you can go and have a look at those websites or those information, and you will get the answer from there. But yeah, this is what is on the debt, the raising of the capital part. I thought to just cover, and we can then definitely take this. This is what has been been happening in this particular space. So yeah, my agenda was to touch upon these core aspects of it, which I've done. And I am happy to take questions if there are any, given the paucity of time, whatever